Indian companies are swapping rupee liabilities with dollar debt. Why? Because foreign debt is cheaper by 5 to 6 percentage points. And is this a growing trend? Hemant Dharnidharka, MD and Head of Credit Research at SJS Markets, now joins me. Hemant, thank you so much for joining us. Why are, to your mind, companies choosing this route to swap rupee debt with dollar debt? Is it because companies are in dire straits or need to restructure? Or is it also because companies see this as an opportunity to prune down their finance costs?
See, the biggest reason is that the cost of dollar debt is very low at the moment, and foreign investors are looking to invest in debt issued by Indian companies. So there is a very clear arbitrage for the Indian companies to actually swap their rupee debt into a dollar debt, where their interest rates would be much lower. If you know, recently some of the banks have issued debt in the range of 4.5% in the last couple of months. So it makes sense for the companies to actually go ahead and take a dollar debt instead of rupee debt.
You know, Hemant, we've seen quite a few companies do this. SR Group announced this a couple of days ago. Are you seeing more and more companies opting for such swaps?
Absolutely. In the coming few months, we expect more Indian companies to actually come up and issue dollar debt. In fact, very recently, somebody like ONGC said that we'll be issuing dollar debt through ONGC Videsh rather than using their own funds, because they said that their own funds can be used for the Indian capex. Reliance has done something similar, where its US operations took a dollar debt. We are likely to see a lot more dollar debt issuances in the coming months.
To your mind, is the downside risk to such swaps, Hemant? You know, if domestic interest rates start cooling off, maybe early next year, if rupee continues to weaken, would you say this trend may cool off?
See, the risk over there is the currency exchange risk. Because if you look at the recent past, the Indian rupee has been depreciating against the dollar, and that could increase the INR liabilities of the companies if the rupee depreciates further. But at current levels, it is expected that the rupee should not depreciate as much as it has in the last 1 year.
Sure.
So the companies are willing to take that risk, and in a lot of cases, the companies are actually hedging their USD INR exposure. So I don't really see this trend stopping anytime soon, because the difference is so large that even if the Indian interest rates were to come down by a couple of percentage points,
sure,
the gap will still be good enough for the companies to actually issue a dollar debt going forward.
All right, one final question, Hemant. You know, as a result of these swaps, do you see corporate P&Ls carrying lesser finance costs in fiscal 13-14? Do you see corporates getting perhaps a bigger headroom to borrow more?
Yeah, absolutely. Because of the lower cost of funding, the corporates will have a lower interest cost, and that would allow them to borrow a bit more to keep their leverage ratios unchanged.
Okay, we'll have to leave it there, Hemant. I'm afraid we've run out of time. Hemant Dharnidharka of SJS Capital Markets on this whole why dollar debt is so hot at this point in time. Up next in business, James